Hello, and welcome to the latest installment of EO Convos. I'm Matt Cropp, the co-executive director of the Vermont Employee Ownership Center, and I'm really excited today to have some time to talk to Blake Jones, who's been involved in a number of kind of co-op and alternative economy projects. He's a founder of the Namaste Solar Worker Cooperative, which is featured in the We the Owners documentary, and so I think has been somewhat widely known as an example of that model in the employee ownership world. He's also sort of been involved in starting kind of clean energy credit union, and most recently has been doing some really interesting work with the Kachuwa Fund, which is, there's been a lot of conversation in employee ownership and co-op worlds around the gaps in financing, and I see Kachuwa as one of the few players that's really trying to model, things that can take equity-like positions at scale in this world. So I think there's a lot to unpack there. So Blake, excited to have you on. Do you want to start by just telling us a little bit about your background, how you got into this whole world?
Yes, I started with a civil engineering degree and was really excited after graduating college to go and work for the oil and gas industry, which is interesting to look back on now. But that's how I got started. Fell in love with oil and gas, and fortunately, I gradually pulled my head out of my butt with big thanks to an older brother who's an environmentalist, and got really excited about renewable energy. And getting into renewable energy, I didn't see myself as an entrepreneur at all, but when the solar market was starting to pick up steam here in the United States, I and two others started Namaste Solar. And we thought, well, if we're going to start a company, we're really passionate about solar, but we're also really passionate about believing there's got to be a better way to do business than the conventional norm. And so we started the company as employee-owned, democratic workplace, one person, one vote, no hierarchy, very egalitarian. And we had all these ideas as first-time entrepreneurs. Some of it was just naivete. And one example of that naivete is we didn't even know about the cooperative model, but we intuitively liked the idea of workplace democracy and one person, one vote, and that's how we operated. And a lot of people told us not to do it that way. We were concerned with, were there going to be people who wanted to join our company when we were doing all these quirky things? And much to our surprise, it attracted amazing people who had similar ideals as we did and had similar beliefs that there's got to be a better way to do business than the conventional norm. And that was 15 years ago. And we're now 200 people. We're a thriving employee-owned cooperative. We actually converted to a cooperative about 5 years into it. Once we found out about the cooperative structure, we were inspired by the likes of Equal Exchange and Organic Valley and other longtime cooperatives that are just setting a really good positive example. If it weren't for the positive examples that they were setting, we wouldn't have known about it. But 200 people, there have been a lot of solar companies that have gone out of business in the consolidation and shakeout of that new and fast-growing industry. But it has been our secret sauce. It has been our special sauce to be an employee-owned cooperative, to be a certified B Corporation, to do business the way we've been doing it. And that this whole journey, I've learned so many things, but one of them is that the passion that I had for wanting to do business differently included or became morphed into a passion for cooperatives and the cooperative structure and democratic organizations. And that led to us creating a purchasing cooperative for solar installers. It's kind of like Ace Hardware and True Value Hardware are purchasing cooperatives for mom and pop hardware stores. We created the Ace Hardware for solar installation companies. And that purchasing cooperative then helped multiple of its members convert to employee ownership. Multiple of them are also employee-owned cooperatives or converted to cooperatives, and that was really exciting to geek out on that, to create another cooperative that then was kind of a new ecosystem for other cooperatives. Also, as part of that, we learned that our customers they had a hard time finding financing to buy solar systems from Namaste Solar and the other purchasing co-op members. Most of the financing that was out there was from venture capital-backed specialty lenders, and there were special leases that they were providing, which helped people to afford to buy solar, because it can be about the cost of a new car, like $20,000, $15,000, $25,000 to buy a solar system. So financing is really helpful, but their costs were too high. And we thought, well, maybe banks and credit unions can get into this, because that's where the cheapest financing is for any consumer product. But when we knocked on the doors of lots of different banks and credit unions, none of them wanted to provide a solar loan. So we said, all right, well, we'll do it ourselves. And at first we thought of starting a clean energy bank because I did not know about credit unions. I didn't know that they were actually cooperatives. But when we found that out, we thought, we can't start a bank. It's absolutely got to be a credit union. And that's kind of how the idea of Clean Energy Credit Union was born. It's multiple other clean energy geeks, of which I was one, a few other credit union geeks, and we got together. It took us 3 years to get our federal charter, but we finally got it. And not many new credit unions are being started these days because it's so difficult. But I love that it's a cooperative. It's got a lot of other distinct differences that are very important, how they're different from banks. And Clean Energy Credit Union has now been running for 2 years, and it's providing only clean energy loans. So you can get an auto loan, but it's got to be an electric vehicle. You can get a mortgage, but it's got to be a net zero energy home or a highly efficient home. And it's another example where we were able to use the cooperative model to address a very specific market need and do it in a different way than the conventional norm, do it differently than banks. And it's off to a fantastic start. So that Clean Energy Credit Union was another fun experience with a cooperative. And then the fourth one was Kachuwa Impact Fund, which is, Kachuwa stands for, it means tortoise, and we like the imagery of tortoise. It's slow and steady, and its actual name is Kachuwa Investment Cooperative, PBC, which stands for Public Benefit Cooperative, organized here in Colorado, but its trade name is Kachuwa Impact Fund. And this was born out of a couple things. One was the experience that Namaste Solar had. Namaste Solar has been growing so rapidly over its 15-year history that at the beginning, the employee owners were providing all the funding for the cooperative. But after all the employee owners had invested their life savings, it still wasn't enough capital to keep growing the cooperative. And so we looked to external investors to help us to grow. And early on, we actually thought we could never bring on external investment because we thought that that would cause us to lose control over our mission and our unique way of doing things. So that was actually part of, almost a core value of Namaste Solar in the early years was no external investment. What we really meant was no external control. And then the positive examples that were set by Equal Exchange or Organic Valley and others helped us to believe that it was actually possible. Like Equal Exchange and Organic Valley have raised millions and millions of dollars from like-minded, mission-aligned investors, and who are investing in them because they're cooperatives, because of the way they're doing things, and they're not looking for that company to grow and sell, and have a big liquidity event. They don't need voting rights or control or a board seat, and that really shocked us. We thought, wow. They're able to find these values-aligned investors. We wouldn't have otherwise thought it was possible. And we thought, let's try to do the same thing. And we got encouragement and help from them. And we ended up having two offerings where we created a class of non-voting preferred stock that pays a 6.5% dividend. We set expectations. We're not ever planning to sell our company. Namaste Solar wants to be employee owned, cooperative in perpetuity. And we were really happily surprised with how we had 130 investors who've invested almost $5 million to support. They're investing us because of what we're doing and how we're doing it and why we're doing it, and that we're an employment cooperative. And that was fantastic. Through that experience, I interviewed every single one of the investors to make sure that they were values aligned, to make sure expectations were set properly and that they knew what they were getting into. And I was so inspired from those interviews of each of those impact investors and what they were doing with their money and how they were aligning their investments with their own values, that inspired me as an individual to say, I want to become an impact investor and start doing that. And it was difficult. I found that it was very difficult to be an impact investor because the types of things that I wanted to invest in weren't on Wall Street. When I looked at socially responsible mutual funds and I looked at the top 20 holdings, none of those companies was inspiring. They were very much the usual suspects, and they might be doing, I know Walmart, if they improve the fuel efficiency of their truck fleet by 0.5 miles per gallon, that adds up to a tremendously positive impact. But it's still hard to get excited about Walmart because of all the other things that it does, even if it's doing some positive things here and there. And you could say the same thing about a lot of publicly traded companies. So I was kind of not enamored with what I found on Wall Street and the types of investments that I could make there and the positive impact that they had. But all of the privately held companies that I met, the cooperatives, the smaller companies, the certified B corporations, the impact they were having, absolutely fantastic. But there was this very interesting issue where they didn't know that they could find impact investors who wanted to invest in them. And they often felt like they had to take investment from the usual suspects, like venture capital funds, private equity funds. And once a company takes investment from those sources, they're basically signing a contract that says, we're going to grow as fast as we possibly can, and we're going to sell within 5 to 7 years so that we can provide a liquidity event, so that we can provide a capital gain to our investors. And then they lose control of their mission, and then it's not the company that the entrepreneur or the entrepreneurs originally wanted it to be. So that's part of the issue. And then another part of the issue is that it's difficult for small companies to raise money through what's called a private offering, which is very different than a public offering. A public offering requires lots of Securities and Exchange, SEC regulations. There's a lot of red tape. You have to do quarterly earnings calls. It's difficult to be a publicly traded company and have public offerings. Well, if you want to do private offerings and you just want to do like what Ben and Jerry's did way back when, where they sold shares to people all over Vermont. Actually, that was a different type of public offering. But if you want to get investment from your friends and family and your customers and people in your community, it's difficult to do. And the way the regulations work, it's usually only possible for that to be available to what's called an accredited investor, which is somebody who's wealthy enough or has enough net worth that for some reason the SEC thinks, oh, they're able to make these types of investment decisions on their own. It's harder for a company to take advantage of them. But to make a long story short, in order to do these types of offerings, they're usually only available to accredited investors, and that's what makes them possible. And so it was hard to find these companies to invest in. And once we did find the companies, it was only open to accredited investors. And so we thought there's got to be a better way to make this easier for somebody who wants to invest in these type of companies. And that's ultimately how Kachuwa Impact Fund was born. And I can, as you can tell, I can keep talking about it, and I will, but I'm going to press the pause button there and see if this is the direction you wanted me to be going in.
Absolutely. No, this is, I think you've been at it a bit longer than I have, but it reflects a lot of kind of some similar experiences to me where in particular, my entree into this was kind of thinking about, okay, if I'm going to be getting some retirement funds, where can I put them that are in alignment with my values? And it being a surprisingly difficult row to hoe to get to the point where I was like, okay, I have a self-directed IRA and I can put that money in the Cooperative Fund of New England, which makes loans to co-ops. And then, occasionally starting to figure out how it's almost like an underground of information around these sorts of opportunities that are of the folks who are really sort of doing the transformative work, and yet are restricted in how they can talk about it and what they can share and all of that. And it's this thing where underlying the sort of sense that, oh, well, in a capitalist market economy, everyone can kind of invest and benefit from their savings and all of that. The reality of all of that infrastructure means that unless you have this almost like an aristocratic designation of the accredited investor, right, who has the sort of like the full rights, and everyone else is kind of like constrained to certain things that make it hard to find those value line things unless you have alternative ways of knowing, right? One thing that's, to me, having learned about Kachuwa, that's very exciting, is that in the sort of co-op development world, you talked about the equal exchanges doing their preferred share offerings, similarly with Organic Valley. So that's been kind of like they've been really sort of path breakers in terms of making folks at least aware that these are viable models.
Yep.
But then you also have this kind of dynamic of, in terms of what is generally available for cooperatives, it's usually looks like debt, right? And so there's some key players who are very important to the ecosystem, community development financial institutions like the Cooperative Fund of New England and Shared Capital and LEAF, Fund, which make loans on much more patient terms, et cetera. But still, as loans, they often require collateral, personal guarantees, and even they, as flexible as they can be, that capital can only go so far and can only fit certain situations. And so, can you talk about a little bit about what you see as the gaps, and then sort of like what the transform or the sort of path for Kachuwa to kind of go from something that was sort of in your head of like, oh, I see these gaps, what can we do about them, to the sort of, all right, we're going to do this thing and here's its architecture and let's hit the road with this and have potentially millions of dollars of value in play.
Yep. Yeah. So the gaps from a company perspective, and we call them impact companies. That could be a cooperative, it could be a certified B Corp. There's a lot of different ways we define impact company, but the gaps from their perspective are they want to, they might want debt, but they also might want equity. Every company is different and their needs are different. So it's that flexibility of meeting their needs, whatever they are, customized. And a lot of them, they don't want to share control. Sometimes they are willing to share control, but a lot of them don't. They want it to be just the employees or the members of their cooperative that have control. They don't want to have to sell their company in 5 to 7 years in order to provide liquidity for the investors. So they're looking for investors who are willing to invest in them for the long term. Patient investors is another way to say that. They're looking for non-extractive investors, investors who are investing in them not just to make as much money as possible, but also who want to support their unique mission and their mission for having a positive impact in the world or positive impact on the specific stakeholders that they're serving. And it's hard to find investors that can provide all those things. Those are gaps. So if you're lucky to bridge one of them, you still might have the other 3 or 4 that are standing in your way. So there need to be more investors out there who are willing to help bridge all of those gaps, or at least as many of them as possible. And then, of course, there are the gaps. We mentioned a few of them from the investors' side. How does an average person on Main Street who doesn't have an MBA, doesn't have finance background, how do they find an investment opportunity like this? How do they participate in it if they're not an accredited investor? How do they do the due diligence? How do they know what they're looking at so that they can evaluate whether or not, what the risks are and what the overall picture is, all the pros and cons of making that investment. And then, do they have enough money to invest? So some people, you might only have $10,000 in retirement and savings, but if the minimum investment required by that company is $25,000, there's not much that you can do. So there are those gaps on both sides that Kachuwa Impact Fund is trying to address, all of them at the exact same time. And here's how we do it. On the investor side, the minimum investment amount is $5,000. And we're hoping to lower that over time because $5,000 is still a lot, but we're just now getting started, so to speak, and that's what we started off with. You do not have to be an accredited investor. The Kachuwa Impact Fund is designed to be very diversified, so that if you are doing a $5,000 investment, it's not in a single company where your eggs are in one basket. It's in kind of the equivalent of a mutual fund, except it's not a Wall Street mutual fund. It's more like a Main Street impact mutual fund. It's very, very well diversified, so that if all you do have $5,000 and you're investing in a conventional way, most investment advisors would recommend you put it in a mutual fund because of that diversification. Kachuwa Impact Fund is trying to provide the exact same thing. And then it's also got a very long-term outlook. So we set the expectation that if you're going to invest, we want you to invest for a long period of time, because that's going to line up well with how we're investing in the impact companies. And that diversification will give you, better, help you feel a little more safe and secure about your money, because you're not going to have to trade it a bunch because, such and such company is not doing well and you need to sell your stock quickly in order to get into something else because trends are changing. No, we want it to be diversified enough that it's going to make more sense for you to be investing in it over the long run. And then on the impact company side, we're trying to address the gaps by saying, if you need debt, great, we'll provide debt. If you need equity, we'll provide equity. If you want it to be non-voting preferred stock because you're a cooperative, no problem. We'll invest however you want us to invest. We are patient investors. So if we're going to invest in you, we're willing to invest for decades, not just years. We don't need you to pursue a liquidity event whereby you're going to have to sell the company at some point in order to give us our money back. We want to make long-term investments, buy and hold type of investments. And actually, I should mention, we do a lot of real estate investments, because sometimes an impact company doesn't need debt. They don't need equity. They actually need to gain control over their real estate destiny. And they're a renter, but they don't want to be a renter because they don't have as much control, or maybe rent keeps getting increased on them, or they can't make the tenant improvements that they want to make, and they want to have a solar powered building, but the landlord won't let them. So Kachuwa Impact Fund oftentimes will help an impact company to buy a building, and we'll co-own that building together. That's another way in which we can support an impact company in fulfilling its mission. So debt, equity, real estate, whatever it is that they want, we'll do it. Patient, we'll do it over the long term. We don't need any control. So if you want us to be an advisor, if you really wanted us to serve on the board because you thought we could bring something to the table, well, great, we'll consider that, but we never ask for it. We don't need the shares to be voting. We're really able to customize it all to meet the needs of what that impact company wants. And our main requirement is that there's high impact, and that we can measure, that we can easily see that this company is trying to do things differently. They're trying to, they care more about their mission than they do about making as much money as possible. There are plenty of companies that we've invested in that they're saying we're trying to do both. We're trying to pursue our mission and have positive impact, but we would like to sell the company in 10 years, and we would like to make a lot of money. That's okay, but it's their choice, not something that we impose on them. And out of all of our different entities that we've invested in, they're across the spectrum in terms of what they're trying to do. But the point is, we're trying to support them in doing what they want to do. There's just got to be high impact, and we measure that in a couple different ways. I mentioned a few of them. One is if it's a cooperative, that qualifies. If it's a certified B Corp, that qualifies. If it's a company that's majority owned by employees, women, or people of color, that qualifies. If it's in renewable energy or sustainable agriculture, those are some of our other impact themes. That's what we call them. And then we look for what I call double word scores, triple word scores, quadruple word scores. So if it's a predominantly made up of women, employee-owned cooperative in the renewable energy sector, great, that's a triple word score. To us, that's higher impact. That's out of all the investment inquiries we get, those go to the top of the list, and we prioritize those the highest because, yeah, we're looking for the most impact possible.
So in terms of the types of businesses that you kind of, and beyond the sort of like impact thing, but thinking about kind of more the distribution as a sort of diversified fund, how do you, I know there was one thing where you aim to have kind of a 60-40 split between real estate and sort of like companies things that if you could explain the kind of reasons for that, but also sort of the question of how do you see approaching the needs of kind of companies that are in more of a growth stage, like thinking about, Namaste Solar with, needing to bring things on to get, larger, to get to the point where it has 200 employees. And how do you see engaging with more sort of startup businesses, or do you see sort of startups as part of the overall strategic picture for this, or do you see startups as kind of falling in a separate bucket?
Yep. I think this can all best be described under the perspective of diversification, or at the other end of the spectrum, concentration. And our board of directors focuses a lot on that, because we think the best way we can serve the needs of our investor members in the cooperative is to be as diversified as possible, not have too many eggs in any one basket. And it applies to all these things you just asked about. So the first one is real estate versus non-real estate assets. We are shooting for a 60-40 split. 60% of the assets are real estate and 40% are non-real estate. There's a couple reasons for that. That 60-40 didn't come out of thin air. It actually came from the Investment Act of 1940, which regulates mutual funds and hedge funds and venture capital funds. We're basically exempt from those regulations. We're not regulated like a normal mutual fund if we're predominantly, if we're 60% of our assets are not investment securities. And for us, kind of the way Kachuwa Impact Fund got started was it really started with buying real estate to help impact companies like Namaste Solar out. And then it morphed into making impact investments with debt and equity and impact companies on the side. So it kind of, that's a little bit how the idea came to us, was like, wait a minute, we've already got we've already been helping impact companies, to co-own real estate. We could create a fund out of this with real estate being the main business, and then the way that's measured from the Investment Act of 1940 is what percentage of your assets are in these things. And we said, well, we've already got all of our assets in real estate. So if we start adding on other types of investments, this will work out really well. So maybe the best way to say it is just from a regulatory perspective. It's a lot easier for us. There's less red tape. There's less compliance costs if we are primarily a real estate company and we do debt and equity investments on the side. But we also really like that real estate provides another way of diversifying. Real estate is completely different than providing a loan to an impact company or making a non-voting preferred stock equity investment in a cooperative. There's actually collateral there. There's actually real property. If the company that we're trying to help does go out of business, you can at least sell the real estate. There's so many benefits to real estate that we like the diversification it brings. Also with real estate, it's providing steady income in the form of rent. That's somewhat predictable, or more predictable than perhaps dividends that are being paid from an equity investment. And then if you hold it over the long run, there's a potential capital gain too. And then lastly, you can also have a lot of impact with real estate that I think a lot of people don't realize. With the real estate that Kachuwa Impact Fund helps to buy, we pursue LEED certification. We try to green up that building, energy efficiency improvements, putting solar on the roof, electric vehicle charging stations. We try to do as much of that as possible, but you can also have impact by who the tenant is that you're trying to help out. And it can be like one of our tenants is an environmental nonprofit. A lot of the tenants we use the exact same standards for choosing them as we do for vetting an investment in an impact company. It's got to be an impact company doing good things in the world. So that adds diversification when there's real estate in the mix, and we need at least 60% real estate. The other thing you mentioned, you were asking about startups. The majority of the requests we get for investment from Kachuwa Impact Fund are from startups, and I don't think that's much of a surprise. That's usually that's the stage in which a lot of companies are looking for money. I think that's also when it's most kind of acceptable for companies to look for money. But we don't only want to invest in startups. We don't want to just be a venture capital fund. We want to invest in very well-established companies, like to use Equal Exchange as an example. Again, Kachuwa Impact Fund is invested in Equal Exchange. It's been around for 40 years. They're paying a very predictable, steady dividend on their non-voting preferred stock. That's very valuable from a diversification, from a concentration risk perspective, for stewarding the money of all of the members of the cooperative. So we do make some investments in startups, but our board of directors kind of sets a concentration limit on how much we can be invested in startups. And that's not just startup, direct debt investment or equity investment. It's also if a startup comes to us and says, hey, can you help us buy a building? Well, there's also a risk that if it's a startup, might go out of business and then it can't pay rent anymore. And then we've got a building that we've got to find a new tenant for. So there is a very real startup risk that we need to be aware of. And that's why we don't want to have too much concentration in startups. And we look for that diversification in everything. So what's the stage of company maturity? Is it a startup? Has it been around for 10 years? Has it been profitable for 20 years? We try to have diversification in that. We try to have diversification in the type of asset it is, real estate, debt, preferred equity, regular equity. We try to have diversification in terms of the impact theme. So we don't want to be 100% invested in cooperatives. We don't want 100% investment in employee-owned companies or women-owned companies. We look for diversification in those impact themes too. But basically every type of perspective we can find, we want diversification in it.
So related to that, for folks out there who are watching on the sort of like seeking investment side versus the sort of seeking places to put their investment side, what does the process look like for you all? And then what is the what are those kinds of themes or things that currently you'd be looking for more of primarily? So kind of given the current asset distribution.
The easiest thing, we have a lot of companies reaching out to us through our website, which is great because we've got a contact form and they can get the conversation started that way. So our website is KachuwaImpactFund.com. Kachuwa is spelled Kachuwa, KachuwaImpactFund.com. And we really prefer it when a company already knows what they're looking for. So say the company is having an offering, they've got a business plan, they've got a prospectus, and they're saying, we're looking for people to lend us money and here's the term sheet. Or we're selling this class of non-voting preferred stock as a cooperative and we're trying to raise $500,000 that way. That's really helpful to us with where Kachuwa Impact Fund is, because they've already made up their mind what they're trying to do. They know there's a very specific way in which they need that help. We do have a lot of companies that come to us and say, we're thinking about raising money, we're not yet sure, we just want to talk to investors and start and figure things out. Unfortunately, because Kachuwa Impact Fund is run by the 5 volunteers who are on the board, we don't have staff yet. We don't have the time to help coach or advise or kind of help a company, an impact company, along on its journey and figuring out what it wants to do. Someday we want to get to that, but that's not where we are right now. So we really kind of request, if you don't have documents to look at, if you haven't made up your mind what you want, then maybe wait a little bit until you have figured that out and then reach out to us and ask. And then that starts the conversation in which we learn about each other and say, do we think we're a good fit? What is it that you're looking for? And see if Kachuwa can help you with it.
And what scales of investments are you looking to sort of place right now? What's the kind of like high and low end, and does that differ depending on the type?
Yep, we want to meet the needs of the company. So we have some companies that we've only invested $15,000 in. We have others that we've invested $500,000 in. We have, if an impact company wants help in buying a 5,000 square foot office, we've done that. And we've also done 50,000 square foot offices that are many millions of dollars. So it doesn't, we don't have a preference in that regard. We do look for diversity. So we're not trying to make just big, $500,000 investments. We do want small investments, big investments, and everything in between. But at the end of the day, it's up to the impact company and what they want. We'll try to help meet their needs. We do have some situations where a impact company will come to us and say, we'll get to know each other, and they'll say, we really want $100,000 investment from you. And we'll say, well, you're a startup. We don't know each other very well, so how about we make a smaller $25,000 or $50,000 investment, and that'll help us kickstart the relationship, and we'll get to know you. And over time, if things are going well, then we'll make more follow-on investments, because we do want a long-term relationship, but we don't know you so well. We're not willing to make as big of an investment right off the bat that you want. Sometimes that has happened.
And so, given that real estate is a major portion of the sort of portfolio, kind of what can you talk a little bit more about sort of like what those investments look like? Is it something where it's is it owning a portion of like the LLC that owns the building, or putting in equity in the company to help cover sort of the down payment on the building for a mortgage or something like that? Kind of, or are there a few different approaches that you use?
There are different approaches. So if we're making an investment in a company to help that company buy the building, we categorize that as as an actual investment. That's a debt or an equity investment in that 40% of our portfolio, and the impact company is choosing how to use it, and it just so happens to be that they're choosing to use it to buy a building. That's great. We can do that. But if it's going to count towards the 60% real estate, then that needs to be where it's actually Kachuwa being a part owner of that real estate, and we do it exactly how you said. We create an LLC. That's specific purpose is to own the real estate, and Kachuwa has tended to be the majority owner of that LLC, simply because Kachuwa is usually putting in the majority of the capital, if not all the capital. Most of the impact companies that come to us say, we don't have any money, but we want your help buying a building and gaining control of our real estate destiny. And we'll say, we can do that. We can provide 100% of the capital. We put that into the LLC. The LLC gets a mortgage from, we're working with like certified B Corp banks or credit unions to buy the building. And Kachuwa doesn't like it if it's owning 100% of the building. So even if we put in 100% of the capital, what we do is we give an ownership stake to the impact company, or in this case, we call it an impact tenant. And they earn that ownership stake with sweat equity. And the sweat equity is that they're kind of the property managers who are also owners and also tenants of the building. And as I mentioned, I'm a big believer in employee ownership. When an employee is also an owner of a company, they're going to be the customer service is better, the quality is better. They're going to take better care of the customer and the work that they're doing. Same thing if you're a tenant that also owns the building, you're going to be a tenant that takes much better care of the building. So that kind of motivational thinking is what we have in applying it to this, that if we share ownership with them, not only is it better for them and helps them pursue their mission and it gives them more upside, but also they're in a position to take better care of the building because they're in and day out, and they earn sweat equity in that LLC that owns the building by being the first line of defense and taking care of the real estate's needs is the best way to say it. So that's usually how we do it. Sometimes the impact tenant or the impact company has money to put in, and that's fine too. What they'll get is they'll get, whatever, if they can afford 40% of the LLC, that's the portion that they'll own. And then the sweat equity that we give them that they earn over time, that just allows their percentage ownership to increase above and beyond what their initial capital allowed them to do. So we're really big into it being a shared ownership model. We don't want it to be 100% owned by Kachuwa. We just think it's better for the long run for all stakeholders involved if we share the ownership that way.
Well, this has been fascinating, and it's learning more about the kind of nitty gritty. So maybe as a last question, would it make sense? I think it would make sense just to get your thoughts on both what you see as kind of coming up for the future of Kachuwa, as what its current scale is, what your aspirations for it are, and sort of what are the sort of gaps in this sort of larger world that you see it as potentially starting to fill, but what's still there that really kind of needs work from your perspective and going forward?
Yeah, Kachuwa is over 10 years old, but I would say it's still in its infancy. It's early in its journey of maturation and an evolution. And I'll give some examples of that. So we have a 5-person board, which is great. It's an amazing board. And we want that board to continue driving the maturation of Kachuwa Impact Fund by, we have an investment policy, but that investment policy it's maybe revision 2. We want to keep revising that and polishing that, making that more sophisticated to make sure that we have a policy that's governing how we're making investments as wisely as possible. We also have an asset management policy that needs to be evolved and polished some more. We want to grow Kachuwa Impact Fund so it can have staff, so they can have, it'll probably start with part-time staff and then go to full-time staff, but we would love to have full-time fund managers who are managing Kachuwa Impact Fund, and that it's large enough to justify that. And those are professionals. The 5 of us who are on the board, we all have different specializations. But as an example, I've never been a professional investment fund manager. I'm not a professional investment advisor. We have a few people on the board who have venture capital experience. We have a CPA. We have a lot of expertise, but it would be great if we were hiring somebody who had 20 years of experience specifically with managing these types of funds or with impact investing. We would love it if we had an investment advisor on staff and that we could provide members of the cooperative with, with help in figuring, doing retirement planning and figuring other things out like that. That would be great. That's another example of how we want to evolve. And then, the easiest example is just we want to keep growing the fund so that we can have more impact and provide more of this friendly capital, and so that we can keep diversifying it. So right now, Kachuwa is about just over 20 million in assets and less than 50 investors and members of the cooperative. We would love to grow it to 100 million in assets and hundreds of investors and members of the cooperative. And even though we might be doing the same thing, just doing it on a larger scale will help us to diversify more, and that diversification is only going to be good for the members of the cooperative. And if we can have 100 million, that means we can write larger checks to impact companies. It means we can make more investments in more impact companies. We can, the real estate that we can own, we're converting more of it to LEED certified, solar powered buildings, all those kinds of things. So those are some examples of some of the ways in which we want to evolve and mature Kachuwa Impact Fund over time.
Thank you so much for taking the time for this conversation. You've been watching EO Convos with Blake Jones of many different organizations, but talking obviously Kachuwa Fund today. This is part of a continued series of conversations with folks doing interesting stuff in the broader employee ownership world. I'm Matt Cropp, co-executive director of the Vermont Employee Ownership Center, and until next time, have a good day.